Hi all, this is Tushar, and in today's video presentation we are going to deal with IFRS 15, revenue from contracts with customers. Alright, so before beginning on IFRS 15, one thing must be noted that IFRS 15 says that each contract with the customer has its own different characteristics and it is an individual, and so revenue has to be recognized separately on each contract. So for example, on the same date, same product is being delivered to different customers, a number of customers. Then IFRS 15 says that revenue cannot be recognized collectively because each customer is different and so the contract is different, and so revenue has to be recognized separately. Alright, so definitions first. Two definitions are really important here. The first is for revenue. What is revenue? It is income arising in the course of an entity's ordinary activities. So it does not include interest or dividend income or other gains and disposals on assets. So income arising in the course of entity's ordinary activities includes sale of goods, rendering of services, contracts to construct an asset. So ordinary activities means core business, alright. And of course, revenue also does not include sales taxes, VATs and GST. Another definition is of a contract. A contract is an agreement that creates enforceable rights and obligations. IFRS 15 advocates the 5-step model for revenue recognition. The first step is identifying the contract with the customer. So IFRS 15 revenue recognition model applies where a contract exists and we know the definition of contract, alright, and all the following 5 criteria are met. What are the 5 criteria? These are: the first is parties have approved the contract by writing or orally or implied by customary practices. The second criteria is the entity can identify each party's rights. The third, entity can identify payment terms. Fourth, contract has commercial substance, like risk, timing and amount of future cash flows are expected to change. And the fifth criteria, it is probable that entity will collect consideration. There is customer's ability and intention to pay. If the above criteria are not met, the entity should continue to assess the contract against criteria stated above. If the criteria are met in future, then entity can apply IFRS 15. And furthermore, if the criteria are not met and the consideration has already been received, then the entity should recognize the consideration received as revenue only when either the entity has no remaining obligations to the customer and substantially all the consideration has been received and is not refundable, or the contract has been terminated and the consideration is not refundable. Otherwise, the entity should recognize a liability for the amount of consideration received. The second step of the 5-step model: identifying performance obligations. At the start of the contract, an entity should assess the goods or services promised in a contract with the customer and should identify as a performance obligation each promise to transfer to the customer either a good or service that is distinct or a series of distinct goods and services that are substantially the same and that have the same pattern of transfer to the customer. A good or service is treated as distinct if both of the criteria are met. The first, independent benefit. The customer can benefit from the good or service either on its own or together with other resources that are readily available to the customer. The second criteria is the entity's promise to transfer the good or service to the customer is separately identifiable from other promises in the contract. Well, there are some factors that indicate that the good or service transferred are not distinct. The first is the entity emphasizes on significance of integration with other goods or services promised in the contract. The second, one or more good or service modifies significantly other goods or services. The third, goods or services are highly interrelated or interdependent between themselves. So now we proceed to the third step, which is to determine the transaction price. The transaction price is the amount to which the entity expects to be entitled. In determining the transaction price, we have to consider the effects of the existence of a significant financing component, non-cash consideration, consideration payable to the customer, and variable consideration. A variable consideration can be included in transaction price if it is highly probable that a significant reversal of the cumulative revenue will not occur. The variable consideration is measured at either the probability weighted expected value. For example, if there are a large number of contracts with similar characteristics, or the most likely amount. For example, if there are only two possible outcomes. In considering the financing component, discounting is not required where consideration is due in less than 1 year. And where discounting is applied, present interest separately from revenue. Alright? Also the discount rate. The discount rate may be stated in the contract, but it should reflect the credit risk of the transaction and represent market terms. Coming to non-cash consideration, this will be measured at fair value, and where this cannot be determined easily, then it will be compared to the selling price of the goods being sold by the entity. There may also be consideration payable to a customer. Examples of this type of consideration include discounts, rebates, or refunds on goods or services provided by the entity. Judgment may need to be applied by the management to estimate the transaction price if there is a degree of variability, such as the consideration being based on timing or whether deadlines are met. The revenue to be recorded will be transaction price less fair value of consideration transferred to the customer or payable to the customer. Coming to the fourth step, allocating the transaction price to performance obligations. This is a small step where a contract contains more than one distinct performance obligation. A company allocates the transaction price to all separate performance obligations in proportion to the standalone selling price of the goods or services underlying each performance obligation. The last step, recognizing revenue as and when performance obligations are met. Revenue is only recognized when a performance obligation is satisfied. A performance obligation is satisfied when the entity transfers a promised good or service to the customer. An asset is considered transferred when or as the customer obtains the control of the asset. What does control mean? Control means the ability to direct the use of and obtain substantially all of the remaining benefits from the asset. In recognizing revenue, there may be two cases. The first is performance obligations satisfied over time. An entity transfers control of a good or service over time and therefore satisfies a performance obligation and recognizes revenue over time if one of the following criteria are met. The first is the customer simultaneously receives and consumes the benefits provided by the entity's performance as the entity performs. The second, the entity's performance creates or enhances an asset, for example WIP, that the customer controls as the asset is created or enhanced. The third, the entity's performance does not create an asset with an alternative use to the entity, and the entity has an enforceable right to payment for performance completed to date. For each performance obligation satisfied over time, revenue should be recognized by measuring progress towards complete satisfaction of the performance obligation. There are various methods that can be used to do this. The first, input methods, and second, output methods. In input methods, proportion of work completed is based on the inputs, for example, costs incurred to date, like resources consumed, labor hours consumed, machine hours consumed, time elapsed, costs incurred. And in output methods, the proportion of work completed is based on assessing how much of the finished product is completed, like surveys of performance completed to date, time elapsed, units produced or delivered, appraisals of results achieved. Now, there may be satisfaction of a performance obligation at a point in time. To determine a point in time when the customer obtains the control of a promised asset and an entity satisfies a performance obligation, the entity would consider the indicators of transfers of control that include: the entity has a present right to payment for the asset, the customer has legal title to the asset, the entity has transferred physical possession of the asset, the customer has significant risks and rewards of ownership of the asset, and the customer has accepted the asset. There is another topic, the contract costs. The costs of obtaining a contract. The incremental costs of obtaining a contract are recognized as an asset if the entity expects to recover them. The asset should be amortized to profit and loss on a systematic basis consistent with the pattern of transfer of the goods or services to which the asset relates. So for the costs of obtaining a contract, if the amortization period is considered to be 1 year or less, the costs may be recognized as an expense when incurred. There is another topic, contract assets and contract liability. When either the party to the contract has performed their obligation, an entity shall present the contract in the statement of financial position as a contract asset. For example, if entity transfers goods or services before the customer pays, or as a contract liability. For example, if the customer pays before the entity performs its performance obligations. Any unconditional rights to consideration should be shown separately as receivable. Another important topic I would like to include is sale with the right of return. There is specific guidance in IFRS 15 for that. It says that in case of a sale with the right of return, recognize all of the revenue for the transferred products in the amount of consideration to which the entity expects to be entitled. That is, revenue is not recognized for goods or services expected to be returned. A refund liability will be required to be recognized in case the goods or services are expected to be returned, and an asset and a corresponding adjustment to cost of sales for its right to recover products from customers on settling the refund liability. Thanks for watching. I hope you found the video useful.